Good morning to everyone in the States and good afternoon to everyone in Europe. It's a pleasure to speak with all of you today. So why do we want to have a webinar on accounting judgments? One reason is that we're seeing sort of accounting-related enforcement actions increasing, and they always will and always have been a mainstay of regulations around the world. And that's partly, of course, because of the reliance that investors and lenders place on companies' reported financial results. We've seen, for example, in 2023, a 22% increase year on year on SEC enforcement-related actions. And we've also seen that in our own workload and the type of mandates that we're responding to and helping our clients with. So today we're going to highlight the significance of accounting estimates in this context. And that's partly because it's a key and very frequent element in numerous accounting investigations, and often lies at the very heart of allegations surrounding inappropriate accounting practices. It's also important to remember that accounting standards and guidelines can't be too prescriptive, and there's an awful lot of delegation to the company, and has to be, to actually roll out and implement robust accounting policies and procedures. And often it's principle-based, certainly over here in Europe. So accounting judgments and estimates lie at the very heart of financial statement reporting and accounting. And like all judgments and all estimates, there is an element of subjectivity. And what we've seen is that different people may draw different conclusions from similar facts, in fact, even sometimes the very same facts. And there could be a large number of reasons for this. Some legitimate. It could be knowledge, experience, a bias, the risk appetite of a specific company. Obviously, we're living in very volatile economic and financial sort of climate at the moment, with interest rate volatility that's been unprecedented, certainly, since for most of my working career. Interest rate hikes going up and up and up. Inflation of both product and services, all impacting how people will differently and variously perceive the same issues. So all this subjectivity and the necessity for judgment and estimates obviously also provides an opportunity for fraudulent conduct. And if there is a fraudulent conduct, there are obviously very serious consequences. We're seeing securities class actions increasing in Europe. Obviously, there are a very established form of civil redress in the States, audit negligence claims, and obviously regulatory enforcement actions themselves. We've also seen in the UK with the recent failure to prevent fraud offences that were introduced as part of the Economic Crime and Corporate Transparency Act of 2023, that false accounting is included in these in Section 17. So what we're expecting in the UK is more accounting-related scrutiny, more enforcement, more nervousness from auditors, and more investigations. So our goal today really is to provide a bit more understanding of these accounting judgments that underpin the financial statements, and again, targeted very much at the lawyers amongst us. We'd be delighted to take questions at the end. But in the meantime, I'm delighted to be joined by two colleagues of mine, Derek Patterson in our London office and Neil Keenan in our DC office. Now, both have got very extensive experience in this area. Derek has been with FRA for over 15 years now in London with me, and joined from industry, having worked in a variety of roles at Ford, at British Airways and EasyJet. In those roles, Derek covered a number of areas, including risk management and accounting judgment, and the latter included quite complex areas such as hedge accounting, aircraft residual value and depreciation approaches, and so on. Neil in our DC office joined us from PwC. Neil co-leads the FRA US investigations practice. Before joining us, Neil was a partner at PwC, and very interesting and very relevant here is the work that Neil conducted when he was a part of PwC's National Accounting Office, which was part of the Office of the General Counsel. And there Neil looked into allegations of accounting fraud that arose in the context of audit clients. So he's got a huge amount of experience investigating things like revenue recognition fraud, earnings management through manipulation of expenses, and also accounting estimates, including impairment and asset valuations. So I'm going to move on very quickly because we have got a lot to cover. And very briefly, we're going to cover, first of all, circumstances that can increase the risk of accounting misjudgments and misstatements. We're then going to move on to a primer on accounting judgments themselves and walk through some case studies. And then finally, recommendations on what companies can do to mitigate the risk of misstatements. And of course, then also the actions to take if there are potential misstatements themselves. So with that, I'm going to pass over to Derek, who's going to cover the first of those interesting topics. Thank you.
Thank you very much, Toby, and good afternoon or good morning to everyone, depending on where you are. As Toby says, I'm going to speak a little bit about external and internal factors that may influence management judgment when preparing accounting and reporting. I think, as Toby referred to, I think the biggest influence on management actually are turbulent economic times, and that's often when we see an uptick in things that go wrong in accounting and reporting. And certainly we have been living in difficult times at the moment post-COVID. Just flashing back to the last economic crisis, which was really 2008, there was a survey conducted back then by the Association of Certified Fraud Examiners, which looked at the instances of identified or investigated fraud, and that certainly showed an uptick. And I think I and many others are expecting to see an uptick come from the current turbulent economic circumstances. So where are we now? We're post-COVID and all the economic distortment that brought, and also issues with auditor sign-off. As Toby referred to, and as we can see on the screen, inflation has rocketed since then. So in the UK and the US, it's touched 9 to 10%. But of course, that's a general measure. Within that, within particular sectors, particularly with commodities and energy prices, the rate of inflation has been much, much higher. And there have been all sorts of effects of war in Ukraine, but also global supply disruptions and imposition of trade barriers. These things have all materially increased prices for companies, as well as denying them often raw materials and products that they need. All of these things feed through and hit profit margins almost immediately and give management some real problems to deal with very quickly. If you layer on top of that volatility in exchange rates, and then the increase in interest rates that have followed the spike in inflation. In the UK here, we've had 14 consecutive rate hikes and 11 in the US, and these have brought to an end the era of almost free money, which has been a kind of aberration in my view, and we've returned to economic normalcy. But what that has done is it means the cost of debt is now, interest expense is now a much more material number in the P&L and affects earnings before tax. But also the increase in interest rates has affected the discount factor that's applied to valuations, so that reduces valuations, but also affects impairment testing. So it makes it harder to justify intangible assets on balance sheets. So these things have all made life more difficult. As Toby referred to, we've also had the Economic Crime and Corporate Transparency Act here in the UK, bringing in failure to prevent fraud. And as we noted, that includes accounting and reporting issues within it. So plenty going on for management teams. It is a turbulent time, and many of these factors are set, I think, to continue for some time beyond. The next slide, please, Nicole. We'll look at some internal factors now, so that you are likely well familiar with this concept of the fraud triangle. So here, where we have three factors which combine together, we can often see an increased risk of something going awry or poor management judgment or a fraud. Looking at pressure, so interesting kind of baseline levels of pressure indicated by surveys of employees indicate that here in the UK, around 75% of them experience medium to high levels of pressure at work. That's similar to US levels, where it's around 77% from similar surveys, with around 57% of them indicating feeling the effects of burnout. And we know that COVID has increased levels of stress for employees. But if you then layer on top of that the external factors that we just talked about, so very rapid changes in cost inputs, affecting financial results. This can very quickly change the position of a company versus its budget, perhaps versus contract terms and conditions, investment cases, or earn-out scenarios. And it can very quickly change the pressure dynamic for a management team to be very, very high indeed. If that's combined with opportunity to do something that's inappropriate, so that could come from lax oversight or weakened financial controls post-COVID, or just a finance team being too thinly stretched to spot something, together with rationalization, then that's when there could be a real problem arise. And with rationalization, that could be both personal, where an employee is thinking about protecting their job or their salary or their bonus, but it could also be someone thinking about protecting a company by buying time for a company to figure out how it might meet a problem, by ensuring there's no volatility in the financial reporting, or that the company just meets its budget or its covenant targets. All of these are valid rationalizations for why an employee might, or a management team might, prepare accounting judgments which are inappropriate. And we've seen in the past, for example, in the UK, you may remember the Tesco supplier contribution issue. And there were some issues with accounting for supplier contributions, even though the underlying targets were not being met. So it does happen. And if there is the right pressure, opportunity, and rationalization, it can feed through and affect companies' financial reporting. Next slide, Nicole. Here there are a variety of other factors, internal factors that may affect management. I'm not going to touch on them all, but the ones that stand out to me and are of interest are lack of controls. So interesting to see in the Financial Times recently, a number of US companies, I think Mattel and Chemours, deferring the publication of their financial reporting and citing lack of financial controls or weak financial controls, and also potential issues with tone from the top. So lack of controls around reporting may lead to issues and insufficient information available for management teams to quickly adjust to where they need to be. The second one that's interesting to me is the failure in the finance gatekeeper culture, together with poor communication between management and accounting teams. And this can happen where you have operating teams or sales teams which are under stress and pressure. They may want to test the line with aggressive accounting and reporting practices. It really needs a strong finance team to both be able to withstand the pressure and to be able to explain the technical requirements of the accounting standards, as well as the ethical standard as to where the line is and where accounting should really be judged. So a variety of factors, both externally and internally, which can affect management teams. Many of them are live at the moment, and therefore are good for us to consider. So I'm going to pass the baton now to Neil to talk about the consequences of accounting misstatement.
Thank you very much, Derek, and hello, everyone. Thank you for joining us today. I think it goes without saying that the consequences of an accounting misstatement or accounting issue can be quite substantial for the company, as well as obviously its investors. From a legal perspective, it may give rise to both internal or external investigations, regulatory enforcement, whether by the SEC, the US PCAOB for auditors, or the UK Financial Reporting Council have all been very active in looking at accounting-related cases. And the fines can be substantial. If we take the Carillion case in the UK, a very high-profile matter, after investigations of their kind of estimates of long-term construction projects and kind of a failure to appropriately recognise revenue, the FCA imposed approximately a £38 million penalty. That was obviously not ultimately charged the company, as the company was forced into liquidation as a consequence of it. But we continue to see, fines within the US. Roadrunner Transportation was fined $9.6 million by the SEC as a result of incorrect write-down of asset values and failure to recognise proper estimates for receivables. Securities class actions, Toby has touched upon these, growing in the European community. In the US, they've been long established. And I believe last year, the average settlement for security class actions involving accounting cases was approximately $38 million, so not insignificant. But beyond that, there are clearly reputational issues through a drop in stock price, reducing of lending facilities, and the inability to attract and retain the best talent, all of which are significant additional factors over and above those that might be legal. So I think going on to following our agenda, please, Nicole. We go on to what accounting judgments are and why are they important. As Toby has alluded to, despite the numerous accounting standards that we put out there, they cannot be sufficiently granular and prescriptive to cover all industries, all companies within those industries, and every transaction that they enter into. So accounting requires an element of judgment, and that is permitted within the accounting standards. So judgments are just assumptions that management make to develop accounting estimates that then feed into the correct accounting and disclosure requirements. In accounting, looking at judgments, in essence, a lot of transactions represent monetary amounts that cannot be observed directly and therefore must be estimated. So that could be, for example, a customer defaulting on a loan. What is the likelihood of that? Or it could be an asset. As an asset impaired, and the only way you look at that is to look at future sales, future cost implications to understand whether a company's asset is in fact impaired. So a sound accounting judgment is absolutely critical in order to derive accounts that are accurate. While there is judgment that goes into this, that does not mean that accountants have full discretion and that they basically are bound by the accounting policies. They're also kind of bound by best practices. And where we've seen companies get into trouble and where we'll touch upon in our case studies are that they basically deviate from standard methodologies the company have adopted or what are considered best practice within the accounting professions. They may use different sources for their inputs or assumptions, or they may choose to ignore or amend available information to obtain a particular outcome that is more beneficial for the company. So we'll now go into a few areas of where we've seen accounting judgments. And I'll start with you, Derek, going on revenue recognition.
Thank you very much, Neil. So yes, this is an interesting area. There are lots of areas within revenue recognition. So, for example, bundling of hardware and software has been something that's been in the public domain quite a lot in recent times. But today we want to talk about specifically IFRS 15 and revenue from contracts, or revenue from long-term contracts in particular. So, for example, if a company has a 10-year contract to deliver across that 10 years, costs will build up in the profit and loss account across the 10 years and accumulate. And the question is, when should the company recognize the revenue and the profit associated with the contract? And I think most of us can see that the answer is not right at the beginning of the contract before it's delivered, and it's probably not right at the end, waiting for the expiry of the final 10 years. And indeed, IFRS 15 gives companies options for recognizing the revenue and profit across the 10-year period in this example. So the standard requires companies to look for performance obligations within the contract, and these are essentially promises to deliver goods or services. And as these promised goods and services are delivered and transferred to the customer, and the customer has control of them, then the company is able to recognize the revenue and related margin against the cost. And one other thing to say here is that companies tend to use a process which is called estimate at completion, EAC. And so the way that this works in practice is that the revenue from the contract is set out across the 10 years, and then management will estimate the cost of delivering the contract across the 10 years. And of course, that can be quite subjective, as we've mentioned. It is a management estimate. They have to take into account the world in which they're living and cost inflation and so on. In doing so, they can estimate the margin, and then as the costs build up and accumulate in the P&L, that percentage of cost completion allows recognition of the revenue and the associated profit in the P&L as the cost is building up at the same rate. One further piece to say on this is that if the management team estimate that the cost of the contract exceeds the contracted revenue and that the contract is therefore going to be loss-making, then the accounting changes. It changes from IFRS 15 across to IAS 37, and it becomes an onerous contract or a loss-making contract. And at that point, the company has to recognise the full estimated loss for the contract in its P&L. This obviously creates volatility. So you've gone from recognizing, if you're halfway through a contract, half of the profit that was anticipated, all of a sudden you have to unwind that and then recognize the full estimated 10-year loss. That brings volatility. Nobody likes volatility in the world of accounting, and so it brings pressure and tension on management teams as to how they're going to handle that situation. So if we go to the next slide, Nicole. The case study here was that a whistleblower alleged that within the estimate at completion, there were overstated revenues and undervalued costs. So we began to look at the management assumptions in the EACs to look at both of these issues. In terms of the revenues then, revenues, you start with the baseline, which is what is in the contract, and that's what should be in the EAC. But the standard does allow consideration of additional revenues, for example, in anticipation of contractual changes or where there are variable revenue considerations. But the standard for recognizing that revenue is that the revenue must be highly probable. Now, this is down to the management team to decide what highly probable means and how it's measured. And so in this instance, we were looking at what we would expect to see to justify a management decision that additional revenues beyond the contract were highly probable. In our view, what we would expect to see would be either independent indicators. So these could be announcements by a customer, there could be letters from a customer, minutes of meetings, independent third-party evidence that would suggest and confirm that extra revenue is going to come. Or it could be an objective documented analysis, so where the company has and the management team have set out a variety of reasons why they believe that the revenue is highly probable, citing evidence and carefully going through and stepping out the facts surrounding why they feel that the highly probable threshold has been met. In these circumstances, we could understand why the revenue would then be represented in the EAC and therefore in the accounts. But in this case study, we could not identify either of those two factors. And so absent that and just having a management assertion, in our view, that extra revenue should not have been included in the EAC or the accounting. On the cost side, where you have a very long project, and in this case, these were long manufacturing contracts over many years. They were complicated with lots of sub-project teams, critical path, project analysis, and so on. And so what we were looking at is does that project plan reflect economic reality? And are the costs associated with the plan incorporated in the cost estimate? And in our view, there was a disconnect. There were things like the surging inflation that we've talked about, and also issues with suppliers not performing in terms of meeting their own contractual obligations within the project. And the process was just too slow in terms of incorporating that information into the updating the costs for these projects. So in this circumstance, we found that there were instances of cost understatement, there were instances of revenue overstatement, and those misstatements were pretty considerable in the hundreds of millions, as you can see there. And those resulted in both removal of some profit from the P&L, but also considering some of the contracts as loss-making, and therefore having to account for the full estimated loss as a consequence. So Neil, I'll pass over to you now for some more on IAS 37.
Yep, thank you very much, Derek. So provisions provide an area where estimates and judgments are required in a number of different areas, and they arise across the accounting balance sheet and P&Ls. So what's a provision? A provision is referred to a liability that a company must recognize if it considers it probable that it will need an outflow of cash to settle that liability. So said another way, it's basically a requirement to set aside funds for a future obligation, i.e. a future payment that relates to something that has already happened. Again, the word probable, Derek used it on his slide, calls for lots of judgment. When is something probable? And within the US GAAP, as well as the IFRS, that basically changes. IFRS has probable as more likely than not, whereas US standard has a slightly higher bar where it's likely to occur. Both of those, as you could imagine, require significant judgment and significant estimate by management, and therefore can be open to certain manipulation if required. If looking at certain examples of what they could be, a consumer goods supplier may offer a warranty to customers for defective goods, and they will be required at the time of sale to recognize a liability for the potential that a customer may return a product for repair. It might be quite easy to actually estimate that, taking the historical average of the number of customers that return and multiply that by the actual cost of repairs to come up with a particular provision that you would book in the financial statements. However, as Derek's alluded to, with changes in supply chain, additional costs, whether it be labor costs or material costs, or different suppliers, meaning that your product might not be as well made as perhaps it once was, these can become much more difficult now than perhaps they were in the past in a more stable environment. If I go to our case study, we had FRA was involved in an interesting matter supporting an industrial manufacturing company. And it was in dispute with a business partner. And this was in connection with a slightly more complicated example where it was related to indemnification agreements. And in fact, back-to-back indemnification agreements that our clients basically had with a third party that was then passed on to their business partner. This basically matter involved the indemnity liability. And that this customer, our customer, was to incur costs to remediate a business dispute along with several other partners. And that cost of resolving the business dispute, the commercial decision, actually passed down to a third party. Now, that third party was responsible, therefore, to actually book a provision. And in doing so, our analysis focused on were they accurately accounting for the particular provision, because the company had suddenly embarked on some M&A deals and some capital expenditure, and that ultimately resulted in them not having the cash flows to settle the obligations to our client. And our client basically disputed their basis of accounting for their obligations under this indemnity agreement. And it was proven that they basically consisted using the most favorable outcomes, despite there being conflicting information that basically showed that their prior budgets and their initial budgets that went into the costs to remediate this issue were actually being exceeded each year. There was a historical pattern of past estimates not being met by actual performance. There was an increase in complexity that was involved in remediating the commercial disputes that was the subject of the indemnity, and none of that was taken into account. Various scenarios that we would typically see run to see which was the most probable outcome were not actually run or failed to consider additional information that was available at the time. It's key to show that one area when it comes to provisions is to basically stress test your estimates. And by that, we mean what was the actual outcome compared with the estimate that you made at the time. And where the actual outcome differs from the estimate, it's very important to go back and look at your basis for estimating future obligations and make adjustments where required. Unfortunately, this didn't happen here. They continued to underestimate their provision and ultimately ended up in litigation, which we helped our customer with. So Derek, I know fair value is an issue that we deal with. You're going to discuss that?
Yes, so very wide subject as we know, but we're going to focus just on one particular question that supports our case study, which is how do you estimate the price that an independent third party would pay for an asset or a liability? And the trap here that management teams often fall into is that they will estimate the price that they feel is the right price, or that the company would feel is the right price. But that's not the test. The test is what an independent third party would pay. So if we look at the next slide, we have a little case study there. So we were asked to review the accounts of a property holding company. We were looking at the profitability of the company and if the loans to the company were secure. Obviously, there was a portfolio of properties on the balance sheet of the company, and on looking at them, we could see that there were mark-to-market valuations of the properties, and that those were based upon external valuation reports. So far, so good. However, when we started to unpick and look more carefully at the valuation reports, there we discovered that the valuations were in fact dependent on estimates of KPIs that the company was providing to the independent valuer. And those were pretty important. So they were occupancy and future prospective rental income from the properties. So they were pretty key to the valuation. And as it transpired, these were not being independently checked or verified by the valuation agent. We looked at them and they appeared aggressive to us versus the situation in the broader market. And also we noted that the consequent valuations based upon those inputs had the properties outperforming the local property market. And so in those circumstances, we flagged those red flags. We also identified from review of the company that it was cash flow negative, absent the loans. And so that called a halt to the loan situation and triggered a potential restructuring of that business. But key to the key question there is, make sure that the valuations genuinely are independent third-party valuations and are not based upon management assumptions. Okay, back to Neil for number 4.
Yeah, thank you, Derek. Well, let's touch upon very quickly one area that, with the 3 that we just talked about, seem to be quite complex areas, and they can be. Inventory, you would think, would be quite simple. But there's a little bit of judgment even coming into an area such as inventory. They're typically measured at the lower of cost or net realizable value. The cost is quite easy. You can actually calculate it mechanically based on what is actually the cost of purchasing it, and then basically putting it in its present location and condition. Net realizable value is what you think you could sell it for. And whatever you can sell it for, where that decreases below the cost, then you're required under accounting to write down the inventory and take a hit. And we had one case study that kind of highlighted this. It was for a fashion retailer. Like anything, fashion comes in and out. I'm still in the decades ago, so maybe not for me. However, basically, we had a client that had a profit warning. As a result of that, their audit committee asked us to come in and look at what caused that. And there was basically a lack of internal communication surrounding when some of their high value stock was basically being sold for amounts that were less than the cost of actually producing that stock. And we learned that this was a failure, and it was too centralized, and it was a failure to basically garner from those on the front lines, the brand managers or those responsible for a key customer account where the product was being sold, or offloaded for that couldn't be sold, as to what it was selling for. And therefore it rose to the inability to write down the inventory in a timely manner, and then gave rise to the profit warning. So not a very complex area in terms of accounting, in terms of inventory, but it can still give rise to issues for companies. So we then kind of move on now to kind of some of the recommendations for how can you mitigate issues pertaining to accounting estimates. We've got kind of 6 areas highlighted here that I'll go through quite quickly in the interest of time. I think the first one, obviously, is just the ethical culture. We've been appointed as the independent compliance consultant on a number of matters on behalf of the SEC. And one common theme that always comes up is basically management. What message does management send about transparency, about basically doing the right thing, and that trumps, achieving company objectives or management objectives. That then is also then basically derived from strong policy and procedures. Going to number 2, companies have to know basically what to do and when. And we find that companies with strong accounting manuals, strong practices about how they derive accounting estimates, what templates are used, what information sources they will use, how they should be documented, is critical to making sure that companies are actually following a consistent approach. That means that they will be accurate from one period to the next and comparable from one period to the next. That obviously leads on to the internal controls. So what controls do you have in place to actually ensure you're complying with such policy and procedures? And I think that again looks at controls around what models, what techniques you're deploying, what information sources are you gathering. And I think the most important thing about this is how you document your judgments, so that when companies get in trouble, you'll have a regulator, an auditor, or a firm like ours come in and retroactively ask, what were you thinking at the time? And we find that many companies do not adequately document their decisions, their thought process, their sources of information, or their rationale for making changes to how they derive certain estimate. And therefore they're on the defensive when in fact, what they did might have been very justified based on the information known at the time. But the lack of documentation often is what gets companies into big trouble. Regular assessments, I think, are really required. And I think that can be done in heavy judgmental areas. So do you understand as a business where your risk areas lie? Do you understand where the biggest potential issues in terms of judgment? Do you understand basically what is the likelihood that one estimate might be different from another by virtue of changing a certain input? So what is the significance of inputs? And that can be done by regularly assessing what's happening. And this goes back to the stress test that I referred to earlier. Are you looking at how accurate our assumptions were based on what actually transpired, and are you making the appropriate adjustments? Number 5 relates to the accounting experience. I think that we found, if you look at some of the SEC's settlements, there's often questions about the actual skill set of those responsible for actually conducting key tasks within the company. So do they have the appropriate knowledge and experience to do the work? And this actually not only refers to in-house accountants, but we're finding more and more PCAOB SEC actions about whether the actual auditing firms that are doing the work actually have the requisite skills and experience under the applicable GAAP and understanding kind of the listing and reporting requirements in the US. And finally, and not by least, is basically reliance upon experts. Derek touched upon real estate, having real estate experts brought in, valuation experts, subject matter experts as well. If you have like an environmental issue or spill, do you have people trained and experienced in those areas? And obviously not to blow ourselves, but the attorneys can play a key role in assessing potential risks and outcomes in key areas like litigation. And accountants like ourselves can also provide some valuable inputs. So Derek, I think you're going to talk about, that's all well said, but what if there is an actual problem?
Yes, thank you, Neil. So Nicole, if you go to the next slide, we can talk a little bit about some of the triggers that may bring to light a potential accounting misstatement. So there's a whole range of ways this could be triggered. So the auditors might stumble across something during the audit. They might not like the audit representation letter. They might just refuse to sign off on the accounts. And increasingly, we're seeing auditors being tougher and more rigorous. So this is going to continue. Whistleblower report I touched on earlier was one of the case studies we were involved in. And we know that companies have been establishing whistleblower lines in line with statutory requirements. This is going to be an area that increases too, maybe post-M&A dispute, looking at subsidiary. Or it could be just a new governance or finance team. It's interesting how often these things come to light with just the appointment of a new CFO who looks at things with cold eyes. So if something is triggered, if we go to the next slide, Nicole, question is where should a company go at that point? And for me, there's a couple of things that are really important here. One of them is the fact that given that the investigation is likely to touch on the financial results and the published financial results, and that one of the big risks is that if there is a fraud and it does touch prior years, then there might be a prior year restatement. then the audit committee are going to be very heavily involved, more so than in a normal investigation, I'd say. And I think that where you have an audit committee with independent directors on it, what they are looking for and what they deserve is a strong independent judgment. The last thing they need from a governance perspective is kind of an echo chamber type review that just confirms where things are. So an independent external investigation, I think, is critical on a major accounting issue. It gives access to the best possible tools, I think. So formal interviews with counsel are the best way, I think, for getting information from interviewees, and it also brings along email and document review. And these two things, I think, give access to far more information in far more depth than either an internal investigation can or just a management review, an additional management review of a particular accounting issue. And they give the audit committee as an output a separate independent judgment and viewpoint, which they can then consider with the company's baseline. An internal investigation, of course, covers much of the same ground, but I do think an external investigation with an independent view is where an audit committee is going to be looking these days. So next slide, Nicole. Where there is an investigation and you as lawyers may be brought in to lead this, then there are some key considerations here to consider, particularly with that risk of prior year restatements. We know, as we touched on earlier, that civil litigation risk in Europe and the UK is rising. Collective actions and shareholder class actions are on the up, as is litigation funding. So first issue here, I think, is privilege. And this is a really thorny one. Anyone that's been involved in any of these investigations know that privilege is a real issue to be dealt with. The fact that there may be a fraud will already have put the auditors in a position where they need to carry out additional procedures. They may want to carry out a shadow investigation, or they may be asking for extensive briefings and understanding of the scope and findings of the company's own investigations. Handling that in a way that does not breach privilege is tricky. It's fact specific, it's party specific, and a really tricky one to deal with. And kind of linked to that also, I think, is also the issue of what's in the audit representation letter and what are the auditors receiving from management and how do they view and judge it. So that's a really major issue here. Second one, I think, is timeline. We have seen, as I mentioned earlier, companies that are deferring publication of their financial reports because of issues, but no company really wants to be in that situation, I think. And so very often you have to conduct these investigations in an incredibly tight timeline. There are lots of interested parties. There's an audit committee. There's a general counsel. There are the auditors. There's the CFO and the reporting team. There's a lot of people to juggle and work with to get to the end of something in a very tight time. There's litigation hold, so preserving information, particularly with respect to identified custodians. But this brings to light the issue of management, representation for those individuals and management team members. They will potentially need their own legal team. There may be insurance considerations and insurance coverage issues to be considered there. And then there's the scoping of the review, which needs to be scoped in a way that's broad enough to deliver a robust and reliable investigation, but also is not one that is so broad that it's impossible to carry out in the time frame. And so here, I think looking for an experienced team who can move quickly and focus on the big issues together with scoping the investigation correctly are really important. And then considering the risk of any restatement that may come as a result of the completion of the investigation. So plenty of things to consider. These are fun, I would say, but they are very high pressure. And so good ones to be involved in. With that, I'll hand back to Toby.
Thanks, Derek. Thanks, Neil and Nicole. So we don't actually have time for questions. If people would like to ask questions, just please email them to us and we'd be delighted to respond. One thing I would say is that hindsight often makes what was a poor judgment look like something far more nefarious. And so context is really, really key. And that's where the interviews and the email review and the close work with the lawyers and the company is so critical. And equally, we've gone on and on about economic uncertainty, but we haven't seen interest rate, foreign exchange, or inflationary headwinds like this, certainly in the last 20 years. And that does make accounting judgments in hindsight much more challenging, and also on a forward-looking basis. So with that, I think we have actually got just one question. I don't know if we have time to overrun. So I think we'll probably just respond to that via email, if that's all right. But thank you all very much indeed for joining us today, and delighted to answer any questions you may have after this is all over. Thank you very much.